You should expect to lose money in the market. Now, I'm not much of a gambler, but I have stepped foot in a casino and watched people lose hand after hand. But inevitably, there's someone in the corner who has both hands raised and is excited that they just hit it big. Sometimes investing in the stock market feels like gambling, but I'm here to tell you why it's not gambling and why you should expect to lose money in the market from time to time. Let's look at the data. Investing is harder than you might imagine. After all, spreadsheets do not have feelings, and the market especially does not care about your feelings. One day, you find yourself excited that everything is working and you feel like you're the next Warren Buffett, and the next day, you find yourself going down the rabbit hole of news article after news article stating that the world is falling apart because of some event that you have no control over. Maybe you can relate to this, but if you can't, then you might not have been invested long enough to have all of these experiences. If you read enough personal finance books, stock market history, or watch enough YouTube, you will hopefully find yourself hearing the phrase, invest for the long term, over and over and over again. Today, I want to break down some of the reasoning that you hear this, but I also want to show you why you should expect to lose money in the market in the short term, and how that impacts your long-term returns. There is a reason that people invest in the stock market, and that is because the stock market has made money even after adjusting for inflation over the long term. This means that there's a good case and reason to invest in it, and if you don't and you leave your money sitting in a bank account, then you will be losing money due to inflation every single year. So it's simple. Take your money, invest it for the long term, and you'll likely have more money than you did even when you started adjusting for inflation. While that's true, it's not easy to hold on for the long term, so I want to help set proper expectations to what that ride will feel like. And trust me, it will not always feel good. For example, the stock market from January 1st, 2001 to 2011 averaged 1.41%. That means that if you invested $10,000 and you waited for 10 years, you would have only made $1,500. And I do not want to glaze over this. There are extended periods in the stock market where returns are not positive or are positive, but it is by a very small amount. Besides the years 2001 to 2010, there are a couple of other periods where this happened. The first was the Great Depression, and the second was a 16-year period from 1966 to 1982. A chart from UBS shows the longest periods of negative real returns in different markets. You'll see that the US had a 16-year period of negative real returns, which is on the low side when you compare it to almost every other country on the chart. Austria is leading the charge with 98 years of negative real returns. That is almost a century of losing money to inflation if you only invested in the Austrian market. Can you imagine investing your money and not having a real return for almost 100 years? It's important to know that returns are never guaranteed, and over a short period of time, they are especially not guaranteed. That is why I said you can expect to lose money in the market. But before we dig into that, I've checked the data behind these videos, and about 80% of you watching aren't subscribed. So if you could, help me out and click the subscribe button to show your support, and let me know in the comments if there's something else that you would like me to dig into the data about. Now, like I was saying, if you're looking at your investments on a daily basis, then you can expect to lose money close to half of the time that you're investing. If you have a longer investing time horizon, then that number starts to decline. For example, take a look at the 1-year returns of the S&P 500 in a chart by Capital Group. This shows that over a 1-year period of time, you can expect to make money about 3/4 of the time, but that also means that you can expect to lose money about once every 4 years on average. And let me be very clear, that 1 year of return will feel bad, and the news will tell you that everything is going to crash, and you probably should run for the hills. For example, here's a PDF by RBC that shows the different reasons that the market was going to crash. To highlight a few in the chart, there's the Great Depression, there's a housing market crash, several wars, president assassinations, and the list continues to go on. However, throughout that entire time, the market has returned all of the historical figures that we talk about, like 8% and higher. So if we know that volatility and drops are to be expected, how are ways that we, as data-driven investors, can prepare ourselves for that inevitable future? One that I'm a big fan of is setting rules for yourself as an investor. Some people call this an investment philosophy statement. This is a statement stating when it is appropriate to make changes to your portfolio. The changes must respond to a changing life event, such as a change of income, a a change of expenses, you change jobs, or some other life event that impacts your finances. This will typically not allow for changes to your investments for things like investing in single stocks, selling because the news tells you to, making large bets based on evidence that you find from some news article, or anything else that is not due to a life change. Setting rules for yourself allows you to figure out that if what you want to do with your money comes from emotion or if it comes from a change of circumstance. This will guide you to make less emotional decisions when volatility happens. Secondly, dollar cost average. This is investing regularly no matter what the market is doing. Although it is true that investing in a lump sum as soon as possible will often outperform dollar cost averaging, there is something emotional about being able to contribute to your investments whenever the market is low. If you're buying consistently, volatility can be your friend because you're buying stocks at a price that is at a 5 to 10% discount than they were 3 months ago. I think of dollar cost averaging as a way to make investors resilient. You give yourself a mental shield to small downturns because you turn those downturns into opportunities. If you're retired and you're not earning money, that is when asset allocation and rebalancing your portfolio, watch my last video if you don't know what I'm talking about, becomes more important to fight the volatility of the market. Third, and you probably knew I was going to say this, diversify your investment portfolio. Volatility is associated with risk, and for example, digital assets have an extremely high risk as measured by their volatility, but within an investor's portfolio could have a place in the mix of assets that they own. They have shown periods of different returns than the market and strong performance since inception depending on the asset. However, if you only held digital assets, you would have years where you tripled your money and years where you lost 80+%. That volatility is extremely hard to stomach and probably ill-advised for most investors. Diversifying the portfolio outside of digital assets would probably make sense for most investors. The same is true with different asset classes, stock indices, risk metrics, account types, and so much more. Diversifying your portfolio will likely help in times of market volatility, so you can stomach the drops knowing that your wealth does not depend on one stock or single asset. Let me know what else you personally use to help with the market volatility, and remember, you will always have periods where the market goes down. This is to be expected, and if used properly can benefit you in the long run. And speaking of the long run, here's one of my videos that illustrates how compound interest really can work for you over time, and how reaching your first $100,000 takes as much time as reaching your first $1 million. Happy investing.